Let's get to First Republic and more on the regional banking sector overall. The embattled regional, First Republic, getting a $30 billion capital injection today from 11 major banks, including JP Morgan, Citi, Bank of America, Wells Fargo, Goldman, and Morgan Stanley. The deal was officially announced a short time ago in a joint statement from Treasury, the Fed, the FDIC, and the controller of the currency. So does this put an end to the turmoil that has roiled the regional banks over the last week? Here to break that down, Chris Marinac, the head of research at Janney Montgomery. Chris, great to have you back. You made the comparison to a banana peel in terms of what the sector is going through. Now, with some hindsight and some developments, do you still feel the same way?
Sure. I mean, this is a solvable problem, and I think that the $30 billion today really helps. This is a sign of solidarity from several banks, and they're stepping up. And this is important because it is cash and deposits, not equity via preferred or common. So this is not a real bailout from the sense of taking equity in the company, but really providing them a lifeline, additional liquidity, and in really many respects, returning the deposits that fled in the past 7 days. Those were deposits that were at First Republic last Wednesday and fled the scene, and now they're coming back from these banks. So it's almost returning to Caesar what was his originally.
So as I understand it, Chris, this commitment of capital is in place for 120 days. What happens after that? Is there some assumption that there will be some sort of dilution at some point in terms of issuing equity to these banks in some form? I'm just trying to piece together why the stock would fall so precipitously in the after hours.
So I think the common dividend has been suspended, and I believe that has more to do with the stock trading since 4 p.m. That common dividend means a lot to a lot of investors, and it's a negative on the short term, but it's a suspension. And so I'm not assuming that that is permanent. It may well return in future quarters. The company certainly has to right size. We think many banks have modest holes on capital due to the held to maturity securities and the unrealized losses. That goes back to square one from what happened at Silicon Valley last week. And the capital repair may be done by the banks on their own through retained earnings and suspending buybacks. In many cases, I think they can self-help themselves. Most of these securities are amortizing and having some payoffs. It's just not happening as quick as we all would like, but it is a solvable problem. I think equity and some issuance to the banks who participated is, again, very unlikely. I think they're more giving deposits and returning what fled from First Republic to their banks in the past several days.
Chris, it's Karen. Let me ask you, even if you don't think they're going to do an equity deal with some of these depositing banks, do you think they do an equity deal in the markets to try to, shore up the balance sheet while they continue to maybe approach the new special window and get their duration back closer to where it should be?
So the need for capital really is a question, Karen, of how big the balance sheet is. If they've shrunk in the past week, and I suspect they have, then the need for capital could be actually less than we think. I do believe that many investors who pulled deposits from First Republic were doing it just out of an abundance of caution to see if the bank would fail. And to some extent, that has made the situation worse the past few days, and now we have to see some of that come back. So if we give them another couple of weeks and months, this can stabilize, and then the bank sees where their new pro forma balance sheet is. Capital most likely will happen because I think they're going to want to record the unrealized loss in some form or fashion, or at least have a roadmap for how those securities are going to transition, and then do some type of restructuring. Again, I don't think it has to be the entire book. It could be a portion. And I think having better information about what was going to amortize and the cash flows that were coming from the portfolio is going to be useful to investors. And I think we'll get more of those details in the weeks ahead.
There are a number of super regionals, Chris, who contributed to this deposit transfer to First Republic. Does that make you feel better about their state of affairs?
Sure. I think it's the right thing to do for these banks. They're helping out their brethren.
But that they're able to help out their brethren. Instead of saying, you know what, I'm gonna pass on this because I might have to do my own.
I think a lot of them view that this was a very unique circumstance, and that letting First Republic fail was not good for the system, which therefore is not good for them. And so it's better to keep their competitor alive and let them fight for another day. And I think to some extent they would like to get reciprocity if they were in the same situation down the road. So I believe that's part of the mission here. And I wouldn't be surprised if that was started on phone calls the past 24, 48 hours of, what can we do to help? And I think that's why you had so many banks step up in this regard.
Chris, thanks for your time again. Chris Marinac.
My pleasure.
Tim, what do you make of all this? Lots happened over the past 24 hours.
Yeah, well, it's interesting because if you think about some of the things that Chris was talking about in terms of also capping on dividend payouts and whatnot, it brings into question right away as an analyst, or what's the analyst community do to banks in terms of the discount factor of where we are today versus 2 weeks ago. The other interesting thing about First Republic, and he just mentioned, are they going to try to realize that unrealized loss because so much pain's already been endured? It's almost as if the market has priced that in. And do other banks do that? Because at a time, and I'm guessing not at a time when the confidence factor is so difficult. But when you consider all the reinforcements that at least the banks have explicitly or implicitly, and I think that's the fascinating thing. But I go back to where I was, 3 or 4 days ago, even before the good news and the cavalry rode in. I just think that banks who had struggled for years to earn a better multiple from the investment community, partially because they were giving capital back, partially because they could give capital back, and that included regionals, and maybe they shouldn't have been. I think we're in a very different place for the banking system, and I think that discount remains for foreseeable.
You're out of your First Republic trade, right?
Mostly, yeah. It happened to work. I mean, the preferreds traded up. The options traded down, as there seems to be somewhat of a cap here. It's fascinating to me, though, if you assume the discount on all the less than great stuff delivered to the window was 25%, which would be a decent-sized haircut, they've only really helped out $3 billion worth.
Right.
Which is kind of amazing.
Amazingly small.
Yes,
yeah,
yes.
Amazingly small.
So talk about the broader market quickly, because I know Carter's views on it. So where we close the S&P is effectively the 200-day moving average. I mean, all this stuff gets us back to where we were the day that Mike Wilson, if you remember, put that tactical bull call on. But I asked Steve that question for a very specific reason. If we're through this and effectively QT is still on the table and the Fed has saved, air quotes, the banks, then we're right back to where we were with the problems we've all been pointing out for the entire time. Inflation is still a problem. The Fed is still hiking rates, and there's still this lag effect. And on top of that now, banks' earnings power, regardless of where rates are going to go, are going to be diminished given all this stuff. So I get why it's bullish in the short term, but nothing's changed in the long term.